Plus, on top of that, there's contracts issues. For example, let's say Countrywide bought this loan from some other originator. The contracts issues that may come up are, how much did Countrywide pay? Did Countrywide pay 90 cents on the dollar for this performing loan initially? Was there a repurchase agreement? Was there, and I'll explain a repurchase agreement. A repurchase agreement is basically where Countrywide might say to the seller bank, in association with buying $1 billion worth of loans, they might say, look, because we've discovered that you guys didn't follow your own underwriting guidelines, anytime a loan goes bad, we're going to check it and compare it with the underwriting guidelines. And if we determine that you guys didn't follow those, you guys have to buy this loan back for some prearranged price, maybe 90 cents on the dollar or something. Part of the other problem with the bailout is that a lot of the repurchase agreements are now no good because the mortgage guys that created these loans are out of business. So there's nobody to buy the loan back from Countrywide. But in theory, that's one factor that the bank might look at in determining how do we handle this specific loan. There's also mortgage insurance. Mortgage insurance could be, the mortgage insurance that typically most people are familiar with is borrower paid. So the borrower gets a loan, it's not a conventional, let's say they got a loan for 95 or 100% of the property value, and then they're paying mortgage insurance. The lenders also, I figured out over the last year and a half, have also sometimes on some portfolios have gone out and bought their own mortgage insurance. So it's a lender-paid mortgage insurance where they take a piece of the payment that you're making on, let's say, an 8% loan. They'll take a sliver of that payment and they'll go out and they'll buy their own policy. Arguably, that was probably really smart of them to do that. At least a few guys in the big lenders figured out, gee, we're all in trouble here. So it could be lender paid, borrower paid. There's also credit default swaps, which are basically large contracts on billion-dollar portfolios for a certain amount goes delinquent. There's some money that the bank can get back from that. There is also FDIC Lost Sharing Agreements that come to play. And I'll quickly put something on the board about that. An example of this is U.S. Bank. U.S. Bank, let's call this U.S. Bank 1. U.S. Bank, it struggles, it fails, the FDIC takes them over or starts to take them over. And let's say there's, I forget how big the transaction, let's say it's 50 billion. U.S. Bank, instead of, the FDIC, instead of saying, look, let's take over the management and servicing of this $50 billion portfolio, which would really expand the size of the FDIC and probably cost your tax dollars and my tax dollars a lot more to do it that way. Instead, they go to Wall Street. The FDIC goes to Wall Street and they say, hey, does anybody want to buy the assets from U.S. Bank? And they say, as an incentive to get you guys to buy this, you guys can form U.S. Bank 2. U.S. Bank 2, you guys put up the, let's say, $5 billion in equity to buy U.S. Bank 2. And as an incentive to get you Wall Street guys to put up this money, we are going to guarantee up to 85% of the principal balance of these loans on the date that we make this transaction happen. So all these assets go into the new entity, U.S. Bank 2, but they come with an FDIC guarantee that says you guys are going to get 85%. What I see in my business, in part because I defend foreclosure suits, is I might have someone come into my office that says, look, I want a loan mod, I want this, I want that. What typically happens, and it took me a little bit to figure out what was happening, is the guys that own U.S. Bank 2, if the property is grossly upside down, let's say it's a $300,000 loan that the property is worth $150,000 if they're lucky, they say, well, gee, let's foreclose on this thing as soon as possible. I don't care if I get 20 cents on the dollar in the foreclosure suit because I'm going to get the other 65 cents out of the FDIC. That, in my estimation, that is yet a third thing where the government has signed up to, it's basically a blank check. the government said, we're going to do this, and it's a complete blank check type operation, and it's probably not even counted in the $830 billion bailout. It's outside of that. There's a lot of contracts that I would say support the banks in various ways. I think eventually, and this is just my broad brush opinion, I think the lenders are going to outsmart our politicians 9 out of 10 times. And so they're going to figure out ways to get paid regardless. Like a lender-driven mortgage insurance policy, for example, or where a lot of these loans were securitized and packaged into trusts. These trusts have certain rules that say how the loans can be resolved. So the loan servicer has, and if it's divided into more than one trust, maybe they have 2 or 3 sets of instructions from 2 or 3 owners or people that are entitled to receive payments from a particular set of loans. They're trying, the loan servicer is trying to juggle, okay, I have this set of instructions that says we're going to do it this way and it's better to foreclose. Another set that says maybe we have to do a short sale and we make more money this way. So there's any number of things that even me as an attorney in defending a foreclosure suit, I could be 2 years into the lawsuit, I could have served the lender with all kinds of discovery, and typically I will never truly get to the bottom of any of these things that I'm talking about to figure out why the lender made XYZ decision or ABC decision. It's just in any particular loan on any day, there's no way to tell.